Hello, this is MeTime Television exploring United States stocks. This video is being broadcast live simultaneously on both MeTime Television and Mijun Television through our partnership. The United States Blue Chip Stock Analysis segment is not about recommending stocks, but rather about looking at these stocks based on data and introducing some lesser known stocks as well. So, it doesn't mean you should buy them right now. Please make your own decisions and judge for yourself. The company I'm going to introduce today is called Peuleoteo Entertainment. I think many of you might be hearing about it for the first time. The ticker is FLUT and they use the name Peuleoteo. This company is a leading global entertainment company in the fields of sports betting and gaming. Let me introduce this company to you by going through the data one by one. Flutter Entertainment. If you look at the recent stock price trend, this company was listed in 2014, so it hasn't been long since it went public. The company was listed on the New York Stock Exchange at roughly $200 per share. Subsequently, the stock price experienced some fluctuations.
Since then,
the stock price has gone up, and compared to the recent 52-week low, it has risen by about 62%. So currently the stock price is around $280. If you look at this company, it was around the time when the stock market was undergoing some corrections. So from last December to after January, when the stock price was continuously adjusted, the volatility was quite significant. Cryptocurrency is heavily influenced by government policies and similar factors, making it akin to an online casino. Those aspects depend on whether the government will grow this industry, shrink it, or how they will impose taxes. Because it's a business that requires a government-issued license, government policies have a significant impact on the company's value and stock price. So it's a company that needs to be much more sensitive to news about the direction of related laws or regulations compared to other companies. Let me give you an introduction. This company is an entertainment company that provides sports betting and iGaming services in countries like the United States and the United Kingdom. It was listed on the New York Stock Exchange in January 2024. This company is leading sports betting and iGaming in the United States, and it has a flagship brand. The flagship brand is called Penduel. If you look here, I captured this from their website, and this is the brand. As you can see, there are various sports like basketball, soccer, baseball, and National Football League to bet on. It's all about placing wagers on these different options. You bet on who will win in a particular game, and based on those bets, the winnings are distributed, and the company takes a commission in the middle. So even if a lot of people bet on one side, since the odds and other factors are all set separately, you can say that the chances of these companies losing money are almost zero. So as long as there are a lot of transactions, it's a structure where they make money. It's like a securities company. Some customers profit, some lose, but the stock exchange earns by facilitating trades. These companies operate similarly. So sports and horse racing are the main types of betting. Next, there are online casinos, and they also have fantasy sports. Fantasy sports are an expanded part of sports betting. You can actually create your own team with real players. You create your own team and have them play in sports games. And if the players in your team perform really well in the actual games, you place bets based on how well those players did. Fantasy sports is a system where you get prize money or winnings based on the amount you bet. So sports and auctions involve betting on actual sports and real auctions. This company holds about 52% of the sports betting market share in the United States and around 26% in iGaming, which means it has a very high share in the United States sports betting market. Competitors include DraftKings, but Flutter's revenue is significantly higher. We'll take a look at that together later on the competitor screen. So currently this business is growing a lot in the United States market. The United States market accounts for about 46% of total sales, and places like the United Kingdom and others make up about 54%. In terms of growth rate alone, the United States grew by about 18% compared to last year. So in fact, the growth of Flutter Entertainment is being driven by the United States. That's how you should see it. The United States is opening up this area quite a lot, especially the online betting market, and the industry is becoming very active and growing significantly. Through these aspects, the United States market is showing annual growth of 8 and 10%, making it a very important region. Recently, there have been some moves to strengthen online gambling regulations in the United Kingdom and Australia. So, in reality, these aspects can be seen as a risk for this company, as they may limit sales growth in the United Kingdom or globally. As I mentioned earlier, depending on national policies, taxes, or regulations like these, there is definitely a possibility that the stock price could fluctuate sharply. Even if the company is currently profitable, news of such risks could significantly impact it. Consider these risks when reviewing your investment. Currently, the United States is driving growth and is in a favorable position with loosening regulations. Securing growth and competitiveness in the United States market will be crucial for Polioteo Entertainment. If you look at whether it's a blue chip company, it's in the top 24%, so you can say, oh, it's a blue chip stock. But the part we really need to pay attention to is right here. This triangle, I've talked about this triangle a lot. This triangle is a characteristic that appears in early growth stocks. So before this company grows tremendously, during this phase the stock price rises a lot, and later on its profitability and monopoly power improve. In cases like this, when a growth stock becomes somewhat of a blue chip stock, the graph is drawn as a pentagon like this. Currently, it's a triangle with a low score in the 24% range. However, as a growth stock, it belongs to a good category. It could be viewed from that perspective. The smart score from the past year also indicates this. The score increased from 14 to 60 points, which is impressive. However, looking at the 60 points alone, you might question whether it's a high score. But there aren't many growth stocks that rise this quickly, so you can say this is a very fast-growing stock. I'll explain at the end of the video how to pick out these patterns that appear as triangles, because sometimes you want to find such stocks again. Is it the blue chip company? Let's examine the financial chart. I looked at it on an annual basis. So last year it turned a profit, and this year sales are up 23% and earnings per share jumped from $4 to $7, which is an incredible increase of about 1,800%. But this percentage doesn't really mean much. Not that it's meaningless, but what it means is that since the company turned a profit, the 24 cents recorded last year is being used as the basis for the growth rate. What we call the base effect is at play here. The base value was so low that the current $4 or $7 looks like a huge percentage increase. That's what it means. But when a company turns a profit, the percentage tends to be quite high for about 2 or 3 years. So the future earnings per share growth rate is likely to be very high, and since more data will come out later, I'll check and update you on that. Right now, the operating profit margin is 6 to 7% and the net profit margin is 3 to 6%. If you look at the past, there was a big gap between them, but as the net profit margin recovers, the gap is narrowing. That's how the margin rate improves and the earnings per share gets better too. It also in the past, operating losses caused the net profit margin to be low compared to the operating profit margin. We need to investigate these operating losses through financial statements and numerical data to determine if they will persist and remain high. Let's take a look right away. If you look here, the operating profit is based on the annualized figure as of March 31, 2025. So, this is the data summed up for the fourth quarter, and it's now $960 million with net profit at $620 million. However, it's now decreasing compared to that time. If you look here, the operating profit difference was about $700 million back then, but now it's about $400 million, right? Since that's about the difference, you can see it's decreasing now. And even in the previous chart, that difference is shrinking. If we look at it, non-operating losses were $480 million as of the end of December 2024. But for the first quarter of this year, it decreased to $96 million. So it dropped by about $400 million. The gap has significantly narrowed and financial costs have also slightly decreased, although not by a large margin. Financial costs will continue if borrowings remain unchanged. The significant decrease in non-operating profits is a crucial point to address. Will these profits not occur in the future? This is a very important question. Let's examine this from two perspectives. First, the easier one on the right, the borrowings. Currently, the borrowings amount to approximately $7.3 billion. So since there hasn't been a big change yet, and depending on the interest rate, it could vary a bit, but as long as it's called financial costs, about $400 million will occur. It's reasonable to say that such a gap will occur in operating profit and net profit. Second, operating profit previously reached $400 million, but has now declined dramatically. This section explores the reasons behind this sharp drop. So this part is a bit of a difficult concept. I found an option liability in the electronic disclosure of the financial statements. This company, now Pax, and another company called Flutter, during the process of merging and acquisition, gave an option. The option to buy Flutter Entertainment stock. The thing is, when you give an option, it means you're allowing someone to buy at a certain price. For example, let's say they gave the option to buy this company at $200. Pax has the option at $200. But from Flutter's perspective, since they have to give shares to this company later or do something like that, it's recorded as a liability. An option is something that comes with the obligation to pay back something later, so it's recorded as a liability. We call it a liability for the option that Pax holds, or Pax option liability, and that's how it's listed here. The problem is it was supposed to be given at $200, but the stock price went up to $300. From Pax's perspective, this means there's a potential profit of about $100 per share from the option. That means Flutter's liabilities increase by that amount, so it's a structure where losses occur by that much. But if the stock price goes up to $350 instead of $300, then the difference becomes even bigger. But while this is advantageous for the person holding the Pax option, from Flutter's perspective, it means their liabilities increase by that much more. So this has to be reflected as a fair value evaluation loss in the fair value evaluation loss. When reflecting options, the option price is affected by various factors, so they take many things into account and calculate comprehensively. So, the company sets the option price by considering things like the likelihood of the option being exercised based on future profits, and various factors like stock price volatility. In the long run, what's important is that Flutter Entertainment makes more money. As the stock price increases, the option's value will rise because it allows buying at a lower price. If the option's value appreciates, Flutter may recognize a fair value evaluation loss. If it remains stable, it's okay. However, if this percentage continues to increase, there's a chance of further losses. If Flutter Entertainment's stock price keeps rising in the future, then this company could continue to incur these losses in its operating profit. But the important thing is, since this is a valuation loss, it's not an actual cash outflow. It's just a valuation loss. When buying stocks, not selling means a valuation loss or gain. Making a profit without selling is just a valuation gain. If the stock price drops tomorrow, that gain can disappear, so it's not a loss that affects cash flow or causes cash to go out. So on the cash flow statement, this part is reflected again, and it adds more to the cash flow. I mentioned this when I gave the introductory lecture on the cash flow statement. There are effects that these fair value evaluation losses have. So, in the operating cash flow, these parts are reflected in the income statement, but since they are not actual cash outflows, they are not reflected in the cash flow. So it shouldn't be a big problem. The income statement indicates potential future operating profit and financial expenses. Financial expenses will remain steady as borrowings are being maintained. Operating profit, to put it simply, will be affected by Flutter's stock price. If Flutter's stock price goes up, it will show up as a loss in operating profit. In summary, the valuation loss reduces the profit and loss statement. However, since no actual cash outflow occurs, the cash flow remains strong. It's a bit difficult, right? This is a bit tricky. The cash flow statement looks strong, with operating activities generating $1.45 billion, while investing and financing activities used $650 million and $550 million respectively. So in terms of cash flow, there's absolutely no problem. Net profit is $620 million, while cash flow from operating activities is $1.45 billion. Look here, look, there's a big difference. The reason for this big difference is that you have to add back the items that reduced the net profit earlier. As we're talking about it like this, the expenses that didn't actually go out as cash but were counted as expenses are added back in the cash flow from operating activities. One of the most representative examples is fair value gains or fair value losses. So when a fair value loss occurs, it reduces the net profit. This isn't actual cash outflow, so you must add back that amount. For instance, last year, around $400 to $500 million went out, so you have to add back $500 million. The company's cash flow is quite good, with around $1.4 to $1.5 billion paid out and approximately $1 billion in surplus pension or free cash flow. Their cash generation ability is remarkably strong due to the factors mentioned, which is why the bottom right corner of the triangle representing cash generation stands out sharply. So even if there are operating losses in these cases, this actually happens when the float is doing well, not when the float isn't doing well. If the stock price drops and performance worsens, then fair value evaluation will result in a profit. So, from this company's perspective, if operating losses are occurring due to the current options, it's actually evidence that the company is doing well. That's the right way to look at it. The stock price volatility is quite severe compared to the steadily improving earnings per share and other indicators of expected performance based on recent data. On the other hand, when it rises, it goes up quickly as well, due to positive movement in indicators like earnings per share. If you look at the growth rate after turning a profit this year with an 1,800% increase, it went up, then the earnings per share is up by 74.49%, which is extremely high. Compared to the sales growth rate, the earnings per share growth rate is much better. That's because for these kinds of companies, once the algorithms, chips, or other things related to typical games are all set up, there isn't much left to invest in after that. When sales increase, net profit margins can improve rapidly in these cases. So the fact that the growth rate drops below single digits in 2027 is something we need to pay attention to. You should keep checking our site weekly to monitor the performance and see if the growth rate in this area recovers to double digits. The stock price could rise significantly based on changes in consensus.
Or it might not.
It may not, so paying attention to those aspects would be wise. Looking at the valuation, in the past this was at its highest for about a year, and at that time it was undervalued. Recently, from around February to June 2025, it has continued to remain very undervalued. So even though the stock price has gone up quite a bit, I mentioned earlier that it's still up 60% from the lowest point. It hasn't surpassed the previous high, but remains significantly undervalued. So the fair price is around this line, and in the long term I think it will probably recover and reach this level. However, if the risks I mentioned earlier or government policies change in the meantime, there's no way for the stock price to avoid dropping. So since the United States is currently an important market, I think it would be easier to keep track if you search for news about the markets operating in the United States or register your areas of interest and receive newsletters about them. So anyway, in terms of valuation, it's currently very undervalued, and if you look at the stock price exponential moving average, you can see that a good signal occurred at that time and the current upward trend is continuing. That's how you can interpret it. Let's move to our website and take a look together. Here you just need to search for Flutter like this. Yesterday it went up by 0.3% and the signal appeared for the first time yesterday. The buy signal came out on July 9th. We're filming this on the 10th, but the buy signal appeared yesterday. July 9th, I think we notified you before the market opened on the 9th based on the closing price on the 8th. I think it's because the trading, the supply and demand and the valuation are all good. So I think it will be interesting to watch and see what happens going forward. And now if you click on the competitors section I mentioned earlier, you can see this form. I think DraftKings has actually been introduced quite a lot in our country. It's one of the companies that has been introduced a lot in our country as a dividend stock, or at least as a company that's known for dividends. Flutter Entertainment may be unfamiliar, but their revenue size is surprisingly large. DraftKings had $5 billion in Q4 revenue, but this company's revenue is nearly triple that at $14 billion, and the price to earnings ratio is positive, while DraftKings is negative. This means DraftKings is still in the red for the fourth quarter total, but this company is in the black. So overall, Flutter Entertainment is a more solid company than DraftKings. If you're curious about DraftKings, you can just click this. I'll show you if you click it. The score is 31 points. There are no trading signals. The valuation is high and the smart score is quite low. Earlier with Flutter, the score was about this high. So compared to DraftKings, Flutter is a much better company in this area and currently has a bit more investment value. That's the size difference right now. So if you use this competitor menu, you can check the current position of this company and things like that. So if you want to get into gaming, you can add companies like Flutter and other entertainment companies in this field to your watch list like this. Like if you click add group like this and select gaming, you can register it and add it to your gaming group. Should I try adding one more like I did earlier? I'll click on DraftKings and press the heart button. I'll add this one to gaming as well. So after adding these two, if I go to my watch list and enter one-stop diagnosis, I can select the menu. And now gaming has been created. If you click on gaming, you can see here, if we click briefly, Flutter is here, you see. Flutter is here and DraftKings is here. There's a big difference. Like Flutter, for example, the smart score shows whether it's a quality company or not. That's here. And then if you look at whether it's cheap or expensive, it's undervalued. So actually the ones here are the top priority companies to invest in. Next, the second priority are good companies that might be a bit expensive, but these are companies that show up because they are growing. Drafting Hengsu is about third priority. So if you just look at the two, Flutter is more attractive for investment. So if you want to compare some companies you're interested in, you can set it up like this. Come into the interest section and take a quick look. If you click for more details, it will explain everything. I think you can make good use of this feature. Next, lastly, I mentioned earlier that I would tell you how to discover companies like Flutter. Just come to the Discovery section and click this. If you click on Discovery Growth Stocks, you'll see a list of companies that appear in that form. If you look here, DoorDash is also a company whose stock price has gone up a lot. You can see it shows up like this. Next, Carvana is another company whose stock price has risen a lot, and a company called C has also gone up a lot. If you click here on the ticker, you'll see the symbol inside, so you can check that. If you scroll down a bit, you'll see Flutter Entertainment appear right away. This one also shows up in this format. So since the companies here have those types of characteristics, I think it will be very helpful for you to analyze them one by one, following the methods we've shared, and expand to other companies as well. I think it will be helpful if you analyze each of the companies here one by one. I will also introduce these companies one by one through the Blue Chip Stock Discovery segment. If you enjoyed this, please subscribe, like, and comment your support. Thank you.